Hello once again. Here we are working our way through the notes from the Global Asset Management Education Forum 4 conference in New York. Now we're on the first set of breakout sessions. In case you're jumping in here at part 5 and wondering how we got to this screen here, you can begin with my website, efficientminds.com. Over here at seminars, scroll down to Game 4 conference notes, click there, and actually you see soon I'll have this hyperlink there. We will go full screen, and let's get rid of this banner, and we're on breakout sessions 1. Okay. All right, first breakout session was a very dynamic speaker from Virtus. And his presentation was on where's growth. You know, the economy's been kind of growing slowly here. Europe has its issues, China has its issues, Brazil, Russia, everybody's got issues. Where do we look to for growth? I couldn't find the presentation on their website. I admit I didn't look hard, but not my presentation, but their presentation from the conference is supposed to be on their website. So when you're bored one day, you can go over there and look for it. Let's see, a couple highlights. What I have in red here, make sure you have evidence to support investment decisions. Yes, that's, I think it's called Platonic reasoning. You do something, but why is it that you do something? Well, make sure you have evidence. Speaking on having evidence, weather. It was very cold this winter here across the United States, in particular on the East Coast and Midwest. Was it really a problem? From the presenter's perspective, yes, but it should only be a temporary problem. It was of the opinion of the Virtus representative that high-frequency trading is here to stay, helps add liquidity to the market. Naysayers would say high-frequency trading perturbs the market or increases volatility. HFT supporters would say it actually reduces volatility and exposure to risk. But the flash crash we had not too long ago occurred when my understanding is it occurred as a result of some high frequency trading programs going awry. So I'll leave it to you to decide whether high frequency trading is a danger or a provider of liquidity in the market. Here, investment decisions need to consider fundamentals, technical analysis, and the impact of high-frequency trading. I mentioned maybe it was part 1 of this, that although I am primarily a fundamental investor, and when you look at my mosaic of analysis, everything here is fundamental investing, perhaps a slight exception for stock screen, but even then, we're looking at fundamentals like price to book. Here, when we're talking about technicals, we're talking about what patterns do we see in the stock price? Is it really high? How's it relative to a moving average? Is there support, resistance, cup and handle? All those things those chartists would mention. Unfortunately, I disregard here, and in the future I will include it there. But the point is, to complete the mosaic of analysis, you need fundamental analysis and you need some technical analysis. And you need to look at the impact of high-frequency trading. He had some interesting thought here about how history repeats itself. That's actually biblical. Nothing is new under the sun. And the notion of looking for years that correlate with the current years, that's pretty interesting. Might be an interesting historical study to see what 10-year window in the past looks a lot like the past 10 years we've seen, and perhaps that will give us some indication of what to expect going forward. But in the end, nobody knows the future. I've heard of bull markets, but never super bull markets. And super bull markets are ones that are extremely long or relatively long duration. There's a few of them on record there. Interesting fact for your Trivial Pursuit night. Every day in 2013, the S&P was higher than it was the last year. So on January 7th of 2013, the S&P was higher than January 7th, 2012. On July 6th or 12th, July 12th of 2013, it was higher than July 12th, 2012. You get the point. So S&P was up last year. This presenter expects a dip in April. That weather impact is supposed to start showing up in financials. You got to know when to exit. And here's an example of a technical signal of when to sell if you're below the 200-day moving average for a sustained period. Now here's where the mysticism comes in. What exactly is a sustained period? Is that 1 day? Is it a week? An hour? I don't know. Nevertheless, another mention of know what you can lose. Another point to point out, another reason to point out value at risk analysis, which is over here in my part 4 presentation. This is one way to calculate, worst case loss. How much can you lose over the next N days? How many dollars you can lose? So that's one way to help address this question. What you can lose. And again, this comes up over and over during this conference. What can you lose? He said VIX in the mid-20s means something. I'm not sure what. I haven't looked into that. Market, let's see. Oh, so he recommended that you invest in hedge funds when market valuations are rich. So when the market is really high, apparently that's where hedge fund expertise in identifying opportunities is good. When the market is low, you don't need a hedge fund manager to help you find bargains. There's plenty around. We have some tailwinds today. Although some prior presenters at this conference said we're not spending enough on research and development, this Virtus gentleman sees that there has been some spending here recently. So that hopefully the spending on research and development and capital expenditures, upgrading factory equipment or repairing factory equipment, will continue to help profit margins. Pretty funny how he summed up Brazil, Russia, India, and China. These are the BRICS, the emerging economies. Brazil is not investable. We'll see on the next slide. It's because they got their hands full with World Cup and Olympics coming up. They've got some government issues, economy issues. Russia's never investable. That sounds like some old Cold War, don't trust the Russian stuff, but after seeing this Crimea, Ukraine issue, maybe there is some merit to it. He said India and China are part of the conversation, so don't count them out. He thinks we're going to have a correction this summer. It'll be an opportunity. He's got some evidence. I like how he presented evidence to support an investment decision. That's a good salient point. Have evidence to support an investment decision. Emerging activity. Oh, Spain. So earlier in other sessions here, I've mentioned that the presenters were pretty bullish on Europe. And here's a couple pieces of evidence to support that investment decision. Spain's treasury dropped from 7 to 4%. Well, we all know where there's risk, there's return. So apparently in 2012, there was higher risk perceived in Spain than there is now. Also, in Germany, unemployment's at a 20-year low. So the European machine seems to be getting itself in order. Japanese real estate investment trust. Now that's interesting. And I like the idea of real estate investment trust if you can't go over to Japan and buy commercial property yourself. I can't, but real estate definitely goes in fairly long duration cycles. I personally haven't looked at the Japanese real estate market, but if it is indeed at a low, and if there are Japanese REITs available, it might be something to consider. He mentioned something about earnings per share growth, or a question came up, is it due to share buybacks? And this gentleman, this presenter, is not worried about it because if companies are spending what they need to spend on CapEx and R&D, then the share buybacks are not being done to inflate earnings per share. They're being done to return cash to shareholders in a tax-free fashion, or not tax-free, lower tax fashion. Again, you can go to my website, efficientlines.com, and over here, learning modules, payout policy. Here I step you through a simple example of how repurchasing stock with returning shareholders by repurchasing stock is more beneficial to shareholders than paying them dividends from a tax perspective. You can look at that on your own. Pay attention to institutional money flow. And again, yeah, Brazil's overextended. Next up, real assets. There's I'm trying to remember what company these folks were from. Well, nevertheless, three main property types that they deal with. Four. Office, apartment, retail, and industrial. Now they look at over a 5 to 10 year horizon, and with a presumed sale at the end of the horizon, how much is this property worth? This is a very good point. Buy in places with net positive population migration. So I made this note here. Don't buy in Detroit. People have been leaving there. It's cold. I wouldn't try to get there either unless I got paid quite a bit. Unfortunately, I don't think Big Three are on a hiring rampage with big paying jobs or not. So they have three valuation methods that they use primarily to value their real assets. Discounted cash flow, and again, different types of properties have different types of holding periods. So when they're discounting cash flows, they're presuming a sale at the end of whatever the holding period is. Another one is the capitalization rate. Simply the value is equal to the cash flow divided by the capitalization rate. What kind of cash flow per year does this property generate? Okay, what kind of return do I need? Capitalization rate divided by that, and that is the value. The other one is comparables, and then they make adjustments for factors that are different. If they're looking at apartment X and they see a sale of apartment building Y, what is different between apartment building Y and apartment building X? Make a comparables adjustment. Having had some bad luck with residential real estate, and I am a bit skeptical of looking at comparables and recent sales prices, because recent sales prices can be artificial, but that's a whole nother issue. I'll leave for another time. Next up, is it time to buy or bail with respect to the stock market? Is it time to jump in or time to jump out? Humans can be impatient, indecisive, fearful, and greedy. So how does that answer your question? Is it time to buy or bail? Here's another reference on why you should do both fundamental and technical analysis. Fundamental is, why is a company worth $20 a share? And technical is, when is the right time to jump in and how far can it go? Okay. Good years tend to follow great years. Okay, let's see here. Here he's talking about the rule of 20. Oh, let me back up. This is a very good point here. If you don't have 14 months to break even, you should not be in the market. Yeah, so at any point in time when you start investing in the market, you could lose money the next day, the next week, next few months. But over a 14-month period, and I don't have the stats in front of me, you should at least break even. But check the stats on your own there. Since 1948, if you do from 1948 until today, the price of earnings of I believe this S&P 500 was 17.4. Consumer Price Index, or a measure of inflation, 1.6. You add those together, you get 19, which is the rule of 20. I should have this bullet next to this one. Stocks are fairly valued when the sum of those two is equal to 20. So 17.4 plus 1.6 is 19, which means they're just about fairly valued. Could go up a little bit more. Now, bear in mind, this 20 number, this is an average. So half the time the sum of these two will be above 20, and half the time the sum of these two will be below 20. So another model to help address, and again we're addressing the question, is it time to jump in the market or not? The Fed model shows that when the earnings yield, earnings divided by price, is higher than the rate on a 10-year, the Fed model says when this is equal zero, stocks are fairly valued. The presenter at the conference mentioned that when this is greater than zero, the subsequent market return has been around 14% on average. Again, that's an average, so half the time it was higher, half the time it was lower. For more information, you can, on the S&P indexes and earnings expectations, you can click on this link here and it'll take you to the S&P indices website. Somewhere over here, yeah, right here where it says additional info, you can get index earnings. So, okay. And yeah, moving on. You can use the rule of 20 to forecast based on forecasted earnings. I just showed you where to get those. Forecasted inflation, you can get that from the TIPS Treasury differential, or I don't know where you get a consumer price index forecast. But the TRIPS Treasury differential, for those advanced users out there looking to do some math, on my website here, let's see, where would that be? Teaching, class resources, on my OneDrive here. Where is it? No, maybe not. Let me try this one more time here. Efficient mind. That link is not working. Let's try it one more time and I'll give up. There. Not sure why that wasn't working. I'll have to look at that later. I have over here bonds and interest rates. Where is it? Just forward rates. Forward rates and negative rates. Both of these files will show you how to compute expected inflation by looking at the differential in the Treasury inflation protected security prices and regular Treasury prices. Okay. Let's see. January top gaining sub-industries have some information about what's going to happen. You may have heard the old expression, sell in May and go away. So 72% of the time, majority of the time, that's true. Time period outside of May outperformed the time period in May. But even then, still from May to October, it's up 1.3%. Again, these are averages. If you're looking to make the most out of May, consumer staples and healthcare, where you want to be. I found this to be interesting. 40% of S&P 500 returns, I think that should be an R instead of an is, are from reinvested dividends. So make sure you reinvest those dividends and don't go buy cars with them. So right now we're currently below historical average dividend payout ratios. So we should look to a dividend aristocrat. These are mutual funds or ETFs that focus on stocks that already pay dividends. If they're already paying dividends, it's likely that they'll pay more going forward since we're below the historical average payout ratio. Okay, so that concludes the first set of breakout sessions. Thank you for listening. We'll be back with session 2.